talk about in our closing bell exchange. We have Anthony Chan from Chase with us today, Winnie Sun from Sun Group Wealth Partners, Joe Duran from United Capital Financial Advisors, Kenny Polcari, better known as Telly Savalas, for the exchange here with O'Neill Securities. I'm going to start with you, Kenny P. I mean, this is kind of a wait-and-see market today, isn't it? There's a lot to come this week.
It is, but you know, it was very interesting this morning, and we saw the weakness this morning. We saw the market come right down and find support at the 1950-ish level where it found that support. It kind of bounced off of it. It's testing it. It feels like it wants to be a level where it wants to try to build a foundation. We've been talking about that now for a week and a half, ever since we kind of rallied back up and through, and so it feels like it wants to stay there. But yes, you're right. 150 earnings this week, the Fed on Wednesday, and everyone is going to be waiting patiently to see whether or not they change their tune. Certainly they're going to withdraw, but are they going to leave the door open in the event that the data turns worse?
Joe, what about yesterday's stress test results in Europe? I mean, what did that do for confidence, whether in Europe, in the banking systems more broadly, or just in the way people are going to allocate money, especially as we approach the end of the month here?
I think what you're going to find is people are very relieved that no one has used the weakness in the dollar, the change in oil, to adjust their future earnings outlook. And what we're seeing is a relief rally because there were lots of excuses for that to happen. What we're also seeing in Europe is that things, while weak, the banks appear to be, the central banks appear to be more aggressive and trying to emulate the US model. And what I think you'll see most people doing is actually thinking about reallocating to Europe going forward, because it's really underperformed, and they're about 18 months behind us. So I think what you'll see is continued increases, but a lot more volatility.
Anthony Chan, a lot of people were repeating that mantra, saying Europe is 18 months behind or what have you, that it's the cheaper place, it's a place to be, and then wham, we see what happened with European stocks this year. So again, now that we've gotten through the stress test results, which were largely anticipated, do you expect that people will start to look at Europe again, or no?
I think Europe is an interesting place, but at the same time, I got to be realistic. I have to say that there is still that possibility that Europe slips into a recession. I would put that probability at no more than 20 or as much as 25%, but that means 75% chance that we're straight ahead. When you say that Europe is a year and a half behind, in terms of the central bank, I think they're several years behind. So that's why I took as encouraging today when I saw the German IFO index coming in just a little bit weaker than expectations, because again, where are you getting the most resistance? You're getting it from the Bundesbank. So the weaker the tone of the data out of Germany, the more that's likely to melt. And as for the U.S., that oil price at $80 seems to be a price where traders basically sell first and then ask questions about, is it supply or demand driven? Only when you see oil prices below 80 for a considerable period of time will people really focus on whether it's supply or demand.
Winnie, it occurs to me there are three F's that are affecting the markets right now. You've got the fear, whether it's Ebola or something else going on overseas, the Fed, and fundamentals. Prioritize for me. What's most important to you right now?
I think the most important thing is how people feel right now. I mean, the market right now is a lot like the end of a Halloween movie. You know, it's so scary, and it's certainly unpredictable, and that makes investors really jumpy. But we also saw last week having the biggest rally since January 2013, right? So Ebola is a big fear, geopolitical risk, the European Central Bank, big deal. But also what the Fed's going to be talking about at the end of this week.
Yeah, so fear is a big factor, that's for sure. And what about oil? Crude oil testing $80 a barrel again today. Let's get over to the NYMEX here in New York City. Jackie D'Angelo is covering that. Jackie, I understand you took some money from Dom Chu on the golf course yesterday.
I did actually, but you know, got a little windy towards the back half, so
yes,
we're even for now. But let's stick to oil prices, not my golf game, for a moment, and talk about what we saw today. Another roller coaster by all accounts, hitting an intraday low today of $79.44 before we bounced back up. We closed at $81 even, and we were down just 1 penny. Now, Goldman is saying that we could see oil prices go down to $75 in 2015, and traders are saying this is certainly possible, but we're going to trade these tight ranges based on the technicals until we get there. And of course, this close under 80 is really paramount. We couldn't do it today, but technically that is important. We haven't closed under 80 in 2 years or so. But of course, some good news for consumers at the pump, because RBOB is down to 4-year lows. Retail gas prices are down to 4-year lows. We're looking at $3.08 a gallon is the the national average losing 18 cents in just 2 weeks. Traders are saying they do think these prices will go lower, and the national average now could probably get to under $3. And that will mean that people are saving $50 at the pump a month. They may take that money and choose to spend it elsewhere. Back to you.
Jackie, thank you. As a matter of fact, in New Jersey alone, the average for gasoline is $2.86.
Wait, but she's a golfer?
Come on over. Yes, she is a golfer. Yes.
That's amazing. That's
What,
impressive.
you're surprised by that?
I am. Who's a golfer these days? Well, with the exception of my venerable co-host, of course, who is the world's best golfer, along with Joe Duran. I'm sure, Joe, let's go back to oil prices here and try to settle out whether this is going to take some wind out of the U.S. economy or ultimately be a holiday gift here for the consumer.
Well, I think it's a holiday gift because it's like a reduction in taxes. However, our economy has really shifted to an oil-producing economy, so it's going to have offsetting impact that won't be as positive. So, and where does the money go matters more. So if Apple ends up getting all of that free money, the $600 a year that we're going to save,
right,
it won't be as spread out as maybe we would like.
Kenny, you guys on the trading floor are always watching something. I mean, the guys in Chicago who should be watching bonds are watching stocks right now for direction on the 10-year. How much are you guys watching oil and that $80 a barrel level?
Well, I think you are, because I think there is that perception that a weaker oil is going to be negative. But I got to tell you, I think it's much more of a supply side issue than a demand side. I don't think it's weak demand at all. In fact, you just said it. The other guest just said it. The U.S. has become a major oil producer.
Right.
And so in that sense, it's going to be a boom for certainly the U.S. consumer, as well as, in my opinion, for global consumers. So in that sense, I'm actually looking for cheaper oil to benefit in the long term.
Anthony Chan, I've seen a couple of numbers flying around. There are some, like our friend John Spallanzani, who think we're talking about a $1 trillion tax break, if you will, for the consumer by the drop here in oil prices. Morgan Stanley saying at least $129 billion in additional discretionary income for the consumer this holiday season. Just how big of an impact are we talking as you see it here from lower oil prices?
I see it as a very big impact when you take the average person out there spending, what, a little over $2,500 a year in gasoline, and all of a sudden you see that from June prices are down close to 25%. It is a big boom. The big fear is the demand, but I agree with Kenny. When you look at the breakdown, the way I see it, I would say close to 90% of it is supply and about 10% is demand. And I am encouraged by the two steps that Saudi Arabia has already taken. The first step was reducing supply with Kuwait, and then over the weekend, over the last couple of days, hearing some information out there that they've cut back some of the oil that they're actually supplying, even though they haven't cut production. Remember, they got that big meeting in November. If these prices continue to remain soft, I continue to hope that they will cut a little supply.
Winnie, go ahead.
I was just going to add that some of this is also the increasing dollar. You know, you have to remember, it is denominated in dollars. We've had a big run in the dollar. So at least half the move is just currency translation.
Right. I mean, you got a lot of commodities that have suffered as a result of that. Winnie, how does the individual investor play the energy patch right now? If oil is going to continue lower, does that mean you don't want to invest in oil companies themselves?
Well, you know, that's a good question. I mean, this volatility isn't going to improve anytime soon. I mean, oil is a big factor. It'll probably get weaker before it gets better. But despite how uncomfortable this feels, I think corrections are healthy. And we should be telling investors to be expected for long-term growth. This is healthy and this is necessary.
Fair enough. It's been a tough one, Bill, though, for those names, as you mentioned. Some are down 20, 30, 40%. In other words, people who are looking to go sort of tread carefully into those areas where there might be deep value are looking at the energy space here.
But Kelly, and there's your perfect example. They're down. It's like a sale going on Wall Street, right? And so these stocks are down 20, 30, and 40%. What better time than get in? You don't want to buy them when they're up 50%.
But Kenny, does that only work, though, if oil prices don't keep slipping from here? What if Goldman's right and we go to 70 at WTI in Q2?
Okay, so then you know, it's a matter of plugging it into your model and seeing what it says. But the last thing you should be doing is not running away from them when there's an opportunity to buy these stocks at much cheaper prices.
And you buy big. I would suggest you buy the bigger companies.
Right.
Buy big.
Not the small one. Okay, you got
Thanks,
that.
guys.
Thanks, everybody. See you later.
50 minutes.